Picture this: a state-of-the-art factory, billions of dollars in equipment, precision machines calibrated down to microscopic tolerances, engineers on standby, orders backed up for months. Everything is ready. Funding isn't the issue, demand isn't the issue. And then it stops. Not gradually, not because of a financial crisis, not because customers disappeared, because of something so small you can't even see it. A specific material, a trace element, the kind of thing that barely gets mentioned outside of technical reports. But without it, one critical component can't be built. And without that component, the entire production line freezes. Machines go silent. Workers stand around waiting, not for instructions, but for something that isn't arriving. The company has money, plenty of it. They're willing to pay more, double, triple, 10 times the original cost. It doesn't matter, because you can't buy what doesn't exist in the market. Or worse, what exists but isn't available to you. Pause for a second, because this is where the assumption breaks. We're used to thinking that if something is important enough, money can solve it, that markets respond, that supply appears when prices rise. But in this case, none of that works, because the bottleneck isn't financial, it's physical. And once that reality sets in, the entire system starts to look different. Because if a modern economy can be halted, not by lack of capital, but by lack of matter, then the real question isn't who has the most money, it's who controls the things money can't create. This is where the illusion starts to break. For decades, we've been trained to think in financial terms. Growth is measured in GDP, power is measured in currency strength, and crises are answered with liquidity. Print more, inject more, stimulate more. And most of the time, that framework appears to work because money is incredibly effective at solving financial problems. But it has a hard limit, and that limit is something most people rarely think about. Money cannot print reality. You can create trillions of dollars, lower interest rates to zero, and flood the system with liquidity, but none of that produces a single ounce of lithium, a gram of rare earth elements, or a unit of usable energy if the physical supply isn't there. And this is the disconnect we've quietly built into the system. We assume that if something becomes important enough, the market will respond, supply will increase, and everything will balance out. But that assumption only works when supply is flexible. When supply is constrained by geology, geography, infrastructure, or politics, money stops being a solution. It becomes secondary. Pause for a second and really think about that. We're used to believing that higher prices solve shortages. But in the physical world, there are limits you can't negotiate with. You can't accelerate mining beyond certain thresholds. You can't build a refinery overnight. You can't extract materials that don't exist in accessible quantities. These processes take years, sometimes decades, and during that time, demand doesn't wait for supply to catch up. Now, layer that onto the modern economy. Everything we rely on, smartphones, electric vehicles, data centers, military systems, depends on highly specific inputs. Not generic commodities, but specialized elements that often come from a small number of locations and require complex processing chains. When even one of those inputs becomes constrained, the system doesn't adjust smoothly. It stalls. Factories pause not because they lack funding, but because materials simply aren't available. And that's where the hierarchy shifts. It's no longer defined primarily by who controls the currency, but who controls the inputs, who owns the mines, who refines the materials, who controls the energy required to turn raw resources into usable components. Because in a constrained system, control over these physical layers becomes more powerful than access to capital. A country can print its own money, stimulate demand, and support industries financially, but if it doesn't control the resources those industries depend on, it's operating within limits it doesn't control. And in a world where those limits tighten, dependency becomes leverage for someone else. That's the transition happening underneath everything. We're moving from a system where financial dominance seemed sufficient to one where physical dominance quietly sets the boundaries. And once you see that, the assumption changes.
It's not about how much money exists in the system. It's about whether the system can still access what it physically needs to function at all.
If physical resources are the real constraint, then the obvious question is, who saw this coming? Because these shortages don't appear overnight. They build slowly, quietly, over years, sometimes decades. And while most of the world was focused on finance, growth, and digital expansion, a few players were doing something very different. They were buying the inputs. Take China as an example. Over the past 3 decades, while much of the world outsourced manufacturing for efficiency, China did something deeper than just building factories. It moved upstream. It invested in mining operations, secured long-term supply agreements, and, most importantly, built dominance in refining, the step that turns raw materials into usable industrial inputs. And that last part is critical. Because owning a mine is one thing, controlling the ability to process what comes out of it is something else entirely. Many countries have deposits of critical minerals. Far fewer have the infrastructure to refine them at scale. And without refining, raw resources are just potential. They can't be used directly in advanced manufacturing. They need to be processed, purified, transformed. That's where control concentrates. Now zoom out. Over time, this created a situation where a significant portion of the world's critical material processing became centralized. Rare earth elements, battery materials, components essential for electronics, energy systems, and defense technologies, all flowing through a relatively narrow set of processing hubs. And while this was happening, it didn't look like a strategic move. It looked like economics. Lower costs, greater efficiency, environmental trade-offs pushed elsewhere, supply chains optimized for price, not resilience. But underneath that, something else was forming: dependency. Because once supply chains are built that way, they don't unwind easily. You can't just decide to bring production back and expect it to work next year. Mining takes time, refining capacity takes even longer. Infrastructure, permits, expertise, all of it builds slowly. And during that time, the existing system remains in place. Now pause for a second, because this is where the asymmetry becomes clear. One side controls the physical inputs, the materials, the processing, the infrastructure. The other side controls capital, money, investment, financial systems. And as long as materials are abundant, capital dominates. It directs resources, allocates investment, drives growth. But when materials become constrained, control flips. Because no amount of capital can substitute for missing inputs. You can fund a factory, but you can't run it without materials. You can design advanced systems, but you can't build them without components. You can plan entire industries, but if one critical input is missing, everything downstream stops. This is what makes resource control so powerful. It's not just about owning commodities, it's about controlling the choke points, the stages in the supply chain where alternatives are limited and substitution is difficult. And once those choke points exist, they create leverage. Not necessarily through direct confrontation, but through dependency, through the simple fact that one system cannot function without access to another. Now, this doesn't mean the situation is static. Other countries are responding, investments are being made, supply chains are being reconsidered. But here's the problem: time. Building alternative supply chains isn't a short-term project. It's measured in years, often decades. And during that window, the existing structure remains dominant. So what we're seeing isn't just a competition for resources, it's a competition for time. Who can secure supply before constraints tighten further? Who can build capacity before demand outpaces availability? Who can reduce dependency before it becomes a vulnerability? Because once shortages become visible, it's already late. The groundwork was laid years earlier, quietly. And by the time the rest of the system reacts, the balance of power has already shifted. If critical minerals are the hidden inputs of the modern economy, energy is the force that makes all of it usable. Without energy, raw materials stay buried,
Refineries go dark, and factories stop mid-process. It's not just another input, it's the foundation underneath every other layer. And when that foundation cracks, the effect is immediate. You saw a version of this during the European energy crisis 2022. At first, it looked like a price problem. Energy costs surged. Headlines focused on inflation, on households struggling with bills, on governments trying to cushion the shock. But underneath that, something more structural was happening. Industrial energy isn't optional. Heavy manufacturing, steel, aluminum, chemicals, runs on continuous high-intensity energy flows. These processes can't just be paused and resumed without consequence. A smelter, for example, operates at extreme temperatures. If it shuts down, it doesn't simply restart the next day. The equipment can be damaged. The restart process can take weeks, sometimes months. In some cases, shutdown means permanent closure. Now imagine energy becoming too expensive or unavailable. That's exactly what happened in parts of Europe. Facilities reduced output or shut down entirely, not because demand disappeared, but because the cost or availability of energy made production impossible. Orders still existed, customers still needed the products, but the physical ability to produce them was gone. Pause for a second, because this is the same pattern we saw earlier, but at a larger scale. It's not a financial constraint, it's a physical one. And once production stops at that level, the effects cascade. Steel production slows to construction delays to infrastructure projects stall. Chemical plants reduce output to fertilizer supply drops to agricultural yields are affected. Aluminum smelters shut down to manufacturing inputs disappear to downstream industries feel the impact. Everything is connected, and energy sits at the center of that web. Now layer this with the earlier discussion on materials. Mining requires energy. Refining requires even more energy. Manufacturing multiplies that demand further. So energy isn't just one variable, it amplifies every other constraint. If you have the minerals but not the energy to process them, they remain unusable. If you have the factories but not the energy to run them, production stops. The entire system depends on a continuous flow of power that is often taken for granted until it isn't. And this is where the concept of choke points becomes very real. Energy supply isn't evenly distributed. It depends on infrastructure, pipelines, grids, transportation systems. It depends on geopolitics, who controls supply routes, who can restrict or redirect flow. It depends on long-term investment decisions that can't be reversed quickly. So when disruption happens, it doesn't just raise costs, it creates hard limits. And those limits force decisions. Which industries get priority? Which facilities stay open? Which sectors absorb the shock? Because when supply is constrained, not everything can continue operating at full capacity. And this is the deeper implication. We often think of modern economies as flexible, adaptive, capable of rerouting around problems, and to some extent they are, but only within the boundaries set by physical reality. When energy supply tightens enough, flexibility disappears. The system stops optimizing and starts triaging. And that's when the real vulnerability shows. Because the question is no longer how do we grow, it becomes what do we keep running and what do we let stop? And once a system reaches that point, recovery isn't immediate. It takes time to rebuild capacity, time to restore supply, time to restart what was shut down, time that the system doesn't always have. Which brings us to the next assumption people make, that if something breaks, we can just replace it quickly.
This is where the next assumption falls apart. When people hear about shortages, whether it's energy, minerals, or critical components, the immediate reaction is almost automatic. We'll just find alternatives, build new supply, recycle existing materials, shift production somewhere else, solve the bottleneck. It sounds reasonable, but it ignores one thing: time. Because in the physical world, nothing scales instantly. Take mining, for example.
Discovering a deposit is only the beginning. Then comes exploration, permitting, environmental review, financing, infrastructure development, and finally, extraction. That entire process can take a decade or more, and that's assuming everything goes smoothly, which it rarely does. Now add refining. Even if raw materials are available, they still need to be processed into usable forms. That requires specialized facilities, technical expertise, and significant energy input. Building that capacity isn't just expensive, it's slow. Years of planning, construction, and testing before it becomes operational. So when people say, we'll just build our own supply chain, what they're really saying is, we'll start solving this problem now and maybe see results 10 years from today. Pause for a second. Because demand isn't waiting 10 years. Industries need inputs now. Infrastructure projects are happening now. Energy transitions are accelerating now. And the gap between immediate demand and delayed supply creates something dangerous, a vulnerability window. During that window, the system is exposed. It knows it needs alternatives, but those alternatives don't exist yet at scale. So it continues relying on existing supply chains, no matter how fragile or concentrated they are. Recycling is often mentioned as a solution, and it does help, but only partially. Recycling depends on having enough material already in circulation, and many of the technologies driving demand are still expanding. There simply isn't enough end-of-life material to meet current needs. So recycling can supplement supply. It can't replace it. And this is the uncomfortable reality. The system can see the problem. It just can't fix it quickly. Which means for a period of time, maybe years or longer, the constraints remain in place. The dependencies remain. The risks remain. And during that window, the balance of power stays exactly where it is.
So, where does this leave you? Not in a position to control supply chains, not in a position to secure mining rights or build refineries. That's not the level you operate on. But you are still inside the system those constraints affect, which means the question shifts from control to positioning. Because if the next crisis is driven by physical shortages, then the response isn't just financial. It's tangible. Start with a simple shift in perspective. Most people measure their stability in digital terms: account balances, portfolio values, numbers on a screen. And those still matter. But they're only as strong as the system that allows you to convert them into real-world goods. So ask a different question. What do you own that exists outside that conversion layer? Not as an investment, not as speculation, as direct utility. That could be something as basic as energy independence at a small scale, backup power, fuel, anything that allows you to operate when the grid becomes unstable. It could be physical goods that don't depend on just-in-time supply chains, items you use regularly, things that solve immediate needs. And then there's capability, skills that operate without complex systems behind them, the ability to repair, maintain, produce at even a basic level. Because when supply chains tighten, the value of maintaining what you already have increases. Now, pause for a second. This isn't about disconnecting from the modern world. It's about reducing total dependence on it. You're not replacing the system. You're adding a layer beneath it, something that still functions when the larger structure becomes strained. So, the protocol is simple. A portion of your life anchored in physical reality. A reduction in reliance on uninterrupted supply chains. An awareness that not everything can be solved with money. Because in the end, the question isn't how much you have. It's whether what you have still works when the system doesn't.